Good afternoon, everyone. This is our dividend policy, lecture 11. We'll be discussing today. The questions we're going to cover today is what are the mechanics of dividend payments? What is dividend policy? We're going to talk about in what circumstances would dividend policy be relevant, and in what circumstances would dividend policy be important. Then what are the effects of dividend imputation on returns to investors? And what are the factors influencing dividend policy in Australia? These will be our topics to be covered today. So let's start with the payment of cash dividend. But before we start with that, let's talk about what is dividend. Okay. All right. So now let's talk about what is dividend. So anybody want to tell me what is dividend about? Anyone want to
Yes,
share?
I mean a dividend is a share in the company. It's like an amount of money that gets paid for you if a certain amount of shares were sold.
So dividend is the compensation for the investment you make into the business. The return you are actually getting from making the investment into the business by purchasing the share. Okay, so it says here what dividend is. It says here a dividend is a distribution of part of the earnings of the company to its equity shareholders. Okay, so when you purchase the share of a business, equity, when you become an equity shareholder, okay, so that time what happens that you become the equity shareholders, and from the profit of the business, some money will be given to you. A portion of the profit will be distributed among the shareholders. That part is known as dividend. Okay, so dividend is payment of cash dividends. Okay, the payment of cash dividend. Dividend is provided in terms of cash. So they provide you the cash money. Okay, companies' business decisions involve investment, financing, and dividend policy. The decisions on the company's dividend policy should be consistent with the overall financial objective of maximizing the wealth of the shareholders. So the target is actually, like, a lot of time we only ask the question like, what is the objective of business? So most of us we answer like profit making. Okay, that's true. You see profit making, that's true indirectly, but what they do indirectly is like maximize the wealth of shareholders. What they do is maximizing the shareholders' wealth. That's what they do. Okay. So, making the decision about dividend is actually a financial decision they make. Like in Australia, dividends are usually paid twice a year. A final dividends paid after the end of accounting year, and an interim dividend paid anytime using after the half-yearly accounts are released. Okay. So dividend are corporate earnings, like we said before. Okay. So the board of directors will make the decisions how much dividend, what portion of the profit will be distributed among the shares is decided by the shareholders in annual general meeting. They do that. So, and they may choose to increase the dividend amount that they have paid last year. They may decrease, they may remain the same, or even they decide not to pay any dividend at all. Okay. If I show you here, Apple computers, for example. Apple computers, for example. You will see here that Apple even did not pay dividend for a long time. You will see that. So if we go historical prices, I don't want the daily, let's go for monthly. Okay, historical prices, maximum. Okay. Now you can see here that Apple paid dividend, but look at here, no dividend was paid. Okay, so 1985. Actually, they did actually started in December 80. They started to actually become a public company, and 1985. You see that there is no dividend was paid. 85, 86, 87. So 87 they paid the first dividend. After 7 years, they paid the dividend. Okay, then 87 they paid. Then you can see the dividend was paid. 87, 88, 88 they paid twice. One in February, once in May, one is August. November, 4 times quarterly they paid dividend. You see the dividend they paid, but you see after 1995, I believe, they stopped paying the dividend for 1995. After 95, you see no dividend was paid. See that? 95, 96, 97, 98, 99. See, no dividend was paid. See? 2000. They did this stock split. That's what they did in 2000. For 5 years they did. So it is possible sometimes that business may decide that we're not going to pay any dividend to any shareholders. It's also possible that they might decide that there will not dividend will be paid to anybody. Now let's move on. When a company do not pay dividends, that's a good question actually. When a company might decide that we're not going to pay any dividend. Okay. So before we go ahead, like there is a little bit more to talk in here. In general, most of the shareholders are happy if the received dividend. If they receive the dividend, some shareholders with higher income prefer share instead of dividend payments. Okay, so it depends on what they want in return. Like some of them prefer to have cash dividend. Some of them say, no, I would prefer a share, another share. Don't give me cash money, give me a share. That's why sometimes they say split share, bonus share, these things will come up. We'll talk about it very soon. We'll talk about it that they can make the payment in various forms. Okay. Not necessarily it will always have to be cash payment or cash dividend. Most of the company pay dividend for keeping their shareholders happy. Right now, when a company do not pay dividends, like look, like I'll give an example here about Apple computers. Like when they talk about like when they decided not to pay dividend, is this like 1995? After that, they invested so much money in research and development. They invested so much money in research and development. They invented a lot of new things, and they didn't pay dividends. No cash dividend. Cash money was not distributed among the shareholders. It happened. It happened with Apple computers. So when do they do these things? When they will see there is a future in some other project, they'll say, okay, we are not going to pay you dividend. Now, before I talk about that, I think a little bit more, if I talk, it will be much more clear to you guys if I say a little bit more about it. Like, look, business makes their sales. From the sales, they subtract the expenses and they get the profit. After the profit, then they decide how much money they will be actually paying to the shareholders as dividend. And the rest of the money they will keep within the business, which we know as retained earnings. Okay, which we know as retained earnings. Okay, the money they keep into the business. Now, if they decide we want to keep the total profit within the business, the whole amount will become retained earnings. So then the question will come up if they want to decide that we're gonna keep all the money within the business, not giving anything to any shareholders. No. Okay, at that situation, they must be thinking about like, okay, well, we might get something better. We need money. The business needs money because they are looking at something else. They're trying to invent something or research and development or invest in a new project. They did something with them. Okay. So they say that a growing company with further growth prospect usually do not pay dividends. They have a better prospect. This is also applicable if a mature firm believes that there are new investment opportunities of higher growth perspective. They will not pay dividends. The profit will be invested in a new project, like I said just now. They can actually decide that we're going to actually invest the profit into new ventures. So there are many reasons that could be many reasons, like many reasons that they will decide that not dividend will be dividend. Like for example, Rio Tinto's dividend growth is negative in 2016 because of negative economic outlook of the mining sector worldwide. Okay. All right. Now then, okay, date in here. There's something with date involved in here. Let's talk about a date. There are some of the things to learn here. It's like what is the date of the dividend? Date of the dividend is declared by the firm directors. This is called declaration date. Okay, here is the one. You see this thing. This is the chart we have here. So all these 3-4 items here, like declaration date, date of record, ex-dividend date, and payment date. So these are the 4 dates. We will talk about in these 4 dates. So what they do is that, look, let's say they decided on 15th of May declaration date. What they do on declaration date? Dates the dividend is declared by the firm directors. On this date, the total amount of dividend to be paid is transferred from the retained earnings account to the dividend payable account. But then what happens? Then another date is there, is called date of record. Okay, date of record. Date of record only listed shareholders on the register of the shareholders on the date of record. Like they will record that they have record date. 2 days before the record, this says here, the ex-dividend date is usually 2 business days before the business day. So if the weekend, it will not be considered. Okay, so 2 business dates. This is the ex-dividend date is usually 2 business days before the date of record. So here is the date of record, 27. So it's Tuesday, right? So it's Friday. Saturday, Sunday is off. Saturday, Sunday is off. So Monday, Tuesday. So Friday, Monday, Tuesday is record date. Okay. So ex-dividend date will be Friday. Monday is the payment date. So what is ex-dividend date? Ex-dividend date is usually 2 business days before the date of record. On this date, the share register is closed and the shares start trading ex-dividend. They trade the ex-dividend. Purchasers of shares on or after the ex-dividend date are not entitled to the currently declared dividend payment. So if you purchase a share, let's say 23rd Friday is the ex-dividend date, okay? So if you purchase a share on, let's say, Monday morning, you will not be given dividend. But it's already declared in the past, okay? There's an example in here. This example is just to show you the entries of the dividend entries. So let's have a look in here. On 7th June 2013, the directors of the Rainforest Wood Chip company declared a dividend of $1 per share to be paid on Friday, 19th of July 2013, with the date of record of Friday, 21st June 2013. Just before the date of declaration of the dividend, the firm had 60,000 shares on issue, a cash balance of 300,000, retained earnings of 500,000, and no dividends payable. Determine the ex-dividend date and show that ex-dividend, what the ex-dividend date will be then, which one? Friday 21st, right? Date of record is Friday 21st. So it will be 19. Okay. Counting back 2 days prior to Friday 21st June, or 3 business days before the date of record, including the date of record, we find an ex-dividend date Friday 21st June. No, it will be 19. This should be listed on a timeline. Okay, it should be 19 actually. I cannot try this. It will be 19. All right. So yes. So here the entries are here. So cash is an asset, the debit side. Okay. Cash is an asset on the debit side in here. And we had just before the declaration of the dividend. Dividend payable is 0. There is no dividend will be payable. Dividend will be 0. Retained earnings is 500,000. And dividend payable after the declaration, dividend payable becomes 60,000. So dividend payable at the beginning was 0. Okay. There was no dividend payable. Dividend payable is actually liability. That's why this is on the credit side. Okay. And after that, what they did, they declared a dividend of 60,000. They declared, it becomes now, after the declaration of the dividend, it becomes a dividend payable liability because it declared. After declaring the dividend, it becomes dividend payable. After the payment is made, so 60,000 will be paid, then dividend payable will become 0. Okay. And the cash will be, this money will be paid as cash, so cash will be reduced by 60,000 to 140,000. Okay. Now this one is showed you the entry and the policies, not the policy, entry and how they make the dividend. Yeah, you can say that policy also as well. Okay. So the decisions about dividend, they're gonna pay the cash dividend. Okay. Now dividend reinvestment plan. Under this plan, they will say, okay, we are not going to give you the dividend, we're going to actually reinvesting the money. Okay. So they say a dividend reinvestment plan effectively acts as a system of retaining earnings. But instead of retained earnings, account balance increasing, the value of the outstanding shares increases by the value of the dividend reinvestment. Is that shareholders can choose to receive newly issued shares. So when you say it's a dividend reinvestment plan, under this plan, they're not going to give you the cash money. What they're going to do, they're going to say, we gave you some share. Okay. So let's say you have 20 share, now it will become 21 share, for example. Let's say we're going to give you 1 share. Like this. So they will make an entry under your name that you have now 21 share. But so you got some return, but it's not the cash money in your hand. Okay. But this is a new popular in Australia since they reduce issue cost and also allow shareholders to benefit from imputation tax credit. Okay. So since you didn't receive the money, so it will be also helpful for you tax purpose as well. Now, forms of dividend policy. There are different dividend policies up there. Okay. Dividend policy refers to decision. But in this case, we will talk about what is dividend policy. In this case, we will say that dividend policy is like how much of company's profit should be paid out as dividend and how much will be kept as a retained earnings. Okay. That is the dividend policy. It says this essentially boils down to, okay, so this is the formula they use. Consider the constant growth share valuation model. This is a model they actually show. So P0 is equal to D0 into 1 plus G divided by R minus G. This is the formula they use. Okay. All right, so this is the formula they use. Okay. So what is D0 here? D0 is the dividend for previous year. Okay. So D0 is increased. This by itself increases the P0. So if D0 is increasing, P0 will be increasing. How much dividend is paid plus 1 plus G means G is growth rate. So let's say the company is going to give you 2% growth. It will be 1.02. 1 plus 2% will be 1.02. Okay, so let's say last year your dividend was, let's say, $10 was your dividend. So this year they're going to give you 2% will be 2% of $10 will be 20 cents. Okay. They say this year you're going to get $10.20. 2% divided by R minus G. So this is the formula they use. What will be the price of the share? Okay. So D0 is increased. If D0 is increasing, dividend increases, then P will be definitely increasing. But at the same time, an increase in D0 leaves the less money for the investment. That's decreasing G. So when you decrease the G, you reduce G a little bit. Let's say not 2%, let's say going to give you 0.5%. So look, the point here is this, that the business needs to make a decision on how much they will be giving to the shareholders. If they give a lot of money to the shareholders, business will be suffering from liquidity problem. It will be suffering from liquidity crisis. They need to maintain that liquidity as well. But at the same time, they will have to make sure the shareholders are happy. Okay, yes. Residual dividend policy is followed if a firm pays out as dividend of any profit that management believes cannot be reinvested profitably. So this one means that they think that residual dividend policy is this, that the business thinks, okay, we have money and we have already invested all our money wherever we needed to. Still, we have left over, some money is left over, so distribute it among the shareholders. That's residual dividend policy. Okay, so there are different types of dividend policy we'll talk. Residual dividend policy, one of them. Okay. So how do they do this too? Very simple. Determine how much money they're going to invest, determine the desired level of capital expenditure, capital investment based on the firm's desired mixed financing and capital expenditure, determine the required amount of equity financing. Then they will see how much is retained earnings is needed. And yeah, and they will decide how much they have, and they will make a decision. Constant payout ratio policy is another one, a constant payout ratio policy. They will keep paying that constantly. How much they paid in the past, they keep paying the same amount. Involves paying a constant percentage of earnings each period of dividend. Like from our profit, let's say the business made $10 million of profit and they decide that we're gonna pay out of 10 million, they say that we're gonna pay 10%. 1% they will give into that. So 1 million they will be giving to the shareholders. Regular dividend policy involves payment of a fixed dollar amount. So look, these one, the difference constant payout ratio and regular dividend, both of them are paying, one is paying constantly, but in constant here is actually percentage of earnings. Remember this, percentage of earnings. This is very important. Underline this one, percentage of earnings. That's what they are saying. Okay. If the business make $10 million of profit, they will say 20% of 10 million they will pay, for example. 20% of 10 million. It means $2 million they will pay. So every year they pay 20 million. Sorry, 20%, 20%, 20% every year pay. The percentage remains the constant. But regular dividend policy in this case, not the percentage, but the amount is same every year. Okay. And this is another one is a low regular and extra dividend policy. Involves payment of relatively low dividend each period that is augmented by the extra dividend of if higher temporary earnings are experienced. So yeah, they pay low dividend, but if the company have some extra earnings, they will pay again a little bit more. Now here it comes. Bonus share issues, share dividend. They give you the dividend, share as dividend. Okay, the bonus share issue, they issue bonus share. A share dividend involves the issue of new shares to shareholders instead of dividend. They don't give you the dividend, they give you a share. Okay, in theory, a share dividend would not result in change in the value of shares held by the shareholder, but merely transfer from retained earnings to the share capital. Okay, suppose ABC company, that's an example in here. Just check on this example. Suppose ABC company shareholders equity account currently is as follows. Ordinary share capital is 2.5 million, 50,000 share, each share is $50. They have retained earnings of 600,000. The total shareholders equity is $3.1 million. If the company declared 5% share dividend, 5%, it means 5% of the retained earnings they will give. Okay, a bonus 5% share dividend. Oh, share dividend. Okay, they're not giving any cash. One bonus ordinary share for every 20 shares held. See that it's not about cash money they are giving. They are giving you 5% share dividend. It means that if you have 20 shares, they give you one extra share. Okay. If you have less than 20, you will get a pro rata basis. Okay. And the current market price of the share is $60. The resulting amount of retained earnings will be transferred to ordinary share capital. So they will just transfer the retained earnings to share capital, but no cash money will be given to you. Like in here, we have showed you that the transferring money from the cash. See here, the transferring money from the cash. Look, 300,000 was their cash money. It reduced to 240. Why? Because 60,000 has been given as dividend. That's why. But in this case, in this one, their money is not getting out from the cash. What is happening? Retained earnings was 600,000. 600,000 retained earnings. Now from the retained earnings, they will just add up 150,000 to the share capital. Share capital was how much in the past? 2.5 plus they will add up 150 to 26.5 million. 2.65 million. Okay. So cash is still within the business, but they will show that a dividend was paid. Shareholders will be happy. All right. Share split. We're going to talk about share split. After the bonus issue in the above example, what would the market price of ordinary shares be expected to change, assuming no increase in earnings is expected? Well, in that case, this is 16 to 1 divided by 1.05% share was given, 1 divided by 1 plus dividend amount. So 60 was here, 60 multiplied by this. Now let's move on to share splits. How do they split the share? They say A share split results in a greater number of shares being held by each existing shareholders, but in theory, no changes in the value of shares held need to occur. For example, a 2-for-1 share split results in cash in each shareholder receiving 2 new shares for each existing share held. The share split means if you have 1 share, they give you extra 2 shares. The 2-for-1 share split. All right, share buyback is the interesting one. Share buyback is that share buyback involves a company repurchasing their share, its own share. The repurchased shares cannot be reissued subsequently. Okay, so in the normally it happens when the company has good position and they don't need the money from the shareholder anymore. Okay, take your money, give my share back. That's what the company has to do. So, and this is a good thing. When it happens, everybody knows the company is doing very well. That's why they have so much of money and they don't want other people to have a share in there. A signal that the managers of the firm believe the firm's shares are undervalued. A strategy to discourage an unfriendly takeover. So are they giving a message to them? They are very strong. Now, next topic is dividend policy is irrelevant. How do they mean by this one? Dividend policy irrelevant, they mean here, very simply, I will tell you this way. There are some people that they don't care about dividend. They don't care about dividend. What they care is that the share price is increasing or not. That's what they care. So Franco Modigliani and Martin Miller, in 1961 suggested that the value of the company depends on its earnings, not how much dividend they pay. Some business majors might be taking a loan and giving the dividend to show off we are doing good, keeping the shareholders happy. But the value of the company will be depending on the profit earnings of the business. Okay. So they said if the company performs well, the share price will increase, and the investors are capable enough to make their own cash flows from the stock depending on the need for the cash. So if the shareholders really need money, they can sell some of the share. Share price is increasing, right? That's what they mean. So they mean here that there is no need to actually worry about dividends. So in this case, we're talking about dividend policy is irrelevant. It's not relevant at all. In this case, they think about what main thing is that the share price is increasing, company's value is increasing. If company value increases, share price also increases automatically. That's what they mean here. Okay. If an investor has no present cash requirement, so they says here, if the investor needs, if the investors need more money than the dividend he received, he can always sell a part of his investment to make up for the differences. Otherwise, if the investor has no present cash requirement, he can keep the business as it is. Okay, now the problem is with this one assumption of the model is that they think that business is a perfect market capital. They think that way. That market, that they think that that's what we call that efficient market hypothesis. Efficient market hypothesis, which says that market is very efficient, okay, and share is not undervalued or overvalued, okay. Market, the price they set up in the price the market set for a specific share price is very perfect. That's what they think, but that's not the case in real life. No, shares are sometimes overvalued, sometimes shares are undervalued. It happens. So there are some analysts there who can actually make this decision whether share is undervalued or overvalued. You can check it. They also, this model also assumes there is no taxes and fixed investment policy, no risk of uncertainty. That's what this policy, this model thing, or this person, the Miller and Modigliani, the article they wrote, this theory, they think this way, but it's not the real case. Okay. So there are some criticism for their theory as well. Criticism of Modigliani and Miller theory and dividend policy suffers from following limitations. They have some criticism as well. Perfect capital market does not exist. Like I said, that's not the case. Okay. And there is always tax if you made a profit from the stock market. To pay the taxes to the government, that's for sure. Okay, and there is always some risk involved. Yes. And here is an example. This says, suppose that in a given year, a large company's capital budget requires 50 million of equity financing, that earnings of 70 million are expected. Assume the Modigliani and Miller assumptions hold, and that the firm has no retained earnings from the previous period. How much can the company pay out in dividends without having to issue new shares? So they have expectation of earning 70 million, and they need 50 million for their new investment. So 20 million will be left to us. They have just 20 million. Okay. By how much will existing shareholders' wealth increase? By maximizing, if the maximum amount of dividends paid out without having the issue of new shares. It will become 70 million. Okay. Dividend plus capital gain. Dividend, 20 million dividend was given, and 50 million is actually there. Look, total profit will be there. Share value will increase. Like 50 million they've invested in other project, in other assets. Okay. The 50 million plus, they also have given 20 million as dividend. 50 plus 27 million. All right, let's move on. So here you can see which policy they have used here. They use residual dividend policy here. Residual dividend payout policy is consistent with the dividend policy relevance. So how much is left over, that's what they're gonna pay. So the company made $70 million of profit. They need 50 million for reinvestment. The left over will be 20 million. Pay this 20 million to shareholders. All right. Existence of dividend clienteles. Okay, this says here, companies may tend to attract investors. This is interesting. But if the investors do not, investor clienteles that prefer particular dividend policies, for example, higher dividend to investors requiring higher current income. Well, let's put it in a simple way. That a lot of investors are there. They always watch out that how much dividend they're paying or what is the payment rate. They will see if the business is actually making a good payment on the dividends or not. Are they keeping all the money with the business, or they always try to give some money to the shareholder? This is a very good signal about whether they want to actually attract a better investor or not. That's the interesting one. Yes, we understand dividend may not be relevant, but at the same time, paying dividend is an indication that the company, if you invest in the company, there will be regular income. So a lot of people will be interested in dividend relevance theory. This theory says dividend is relevant. Okay, the dividend relevance result will not hold if any of these present assumptions are not satisfied. First of all, the two major possibilities are: number one, investors are not indifferent. Investors are not same between dividends and the capital gains. Number two, there may be capital market imperfections. Of course, capital market is imperfect. Okay, and the main point here is bird in the hand. Bird in the hand, it means that a lot of investors are there. They will think how much I'm getting. I'm not worried about how much I'm going to get after 5 years. They think about what do I have right now in my hand. Okay, how many bars do I have in my hand? If I have the bird in my hand, it means I'm fine. Okay, there are a lot of people out there. They think about how much do I have right now. They prefer that way. Okay, preference for retained earnings under the classical tax system. Difference in the taxation of individuals and capital gains can lead to a shareholder preference for retained profit. Overpayment of dividend in particular in a classical tax system where there is no individual implications. But under a classical tax system, the payment of dividend is penalized related to the capital gain because company profits and dividends are taxed separately. Does any profit are taxed twice? This is another problem I'm having there. Like when you receive a dividend, you are being taxed for dividend because it's an income. At the same time, if the share price increases, again you have to pay the tax because you have made some capital gain. Okay. So you have bars in the hand and tax preferences and irrelevance. Dividend imputation tax system. Okay. How does the dividend imputation tax system work? Look, the system has been operating in Australia since 1987. Under the system, Australian resident shareholders can receive franked dividend to which tax credits are associated. It means the franking credit is this. That this is very important. These formulas are very important. We need to work on this formula. Okay, this way. Like normally what happens is this, that when you receive dividend, they will tell you how much is the frank, how much franking is there. So they call it franked dividend. Okay, frank. Which means that business company already paid the tax on your dividend, then they gave you the money. Okay, then they gave you the money. So this is called franked dividend. So this says this is the, I think this is the formula. Tax credit will be equal to cash dividend into tax rate divided by 1 minus tax rate multiplied by franking ratio. What percentage is the frank ratio? It's a 50% franking credit. Okay, so they will have to mention that 50% here. I think if we do one problem solving, it will be much more clear. I think it's very important to learn this one. I'm expecting some questions from here in your final exam. This one is very interesting. Look at that, what they do. They suppose a company pays out fully franked dividend, means 100% tax paid. Fully franked dividend of $70 each to investors with marginal tax rate of 90%, 32.5% and 45%. All right. The statutory company tax rate is 30%. How much tax will each investor pay on his or her franked dividend? All right. So 3 group of people, they paid the tax, they paid the dividend. Okay. One is a group of people who is low earners, and when they pay the tax, their tax rate is 19%. Okay. I think I should talk to you a little bit more about this taxation, because otherwise you will get confused. Company pays at 30% tax. Company pays 30% tax. Okay. So company is always paying 30% tax. If company wants to give you $100 of dividend, they will pay 30% tax and they give you $70 in your hand. It means you actually earn $100 of dividend. And what the company did? Company paid $30 to the tax office for you on your behalf, and $70 they gave to you. But all of a sudden you said, oh, I'm a poor man. My tax is not 30%. My dividend is $100, I understand. But why did you pay $30 to the government, Australian taxation office? I pay 19% tax. That time, you can go back and claim ATO that, okay, give me $11 back. My tax rate is 19%. Make sense? That's the case in here. Okay, it says the imputation credit for each investor will be this. $70, the frank dividend of $70 that give the frank dividend into 30% divided by 70. It will be $30. So it means $30 is the tax paid. Okay, as I said, this is the credit you have given. They have given you $30 of tax. Then you found that. So what is your gross income? What is total income? Gross income $100 is your total income. Like the example I just mentioned a couple of minutes ago. $100 is your total income. Then you will say that your tax rate is 19%, then you can receive $11 back. We apply this formula. You see this formula, dividend into tax rate divided by 1 minus tax rate. By using this formula, what do you calculate? You calculate how much tax has been paid on your behalf. Okay. Then you have to add up that tax with how much dividend you have received. Okay. Let's say your dividend is $100. So the company you invested, they said we're gonna give you $100 dividend, but we cannot hand over you $100. How much you gonna hand you over? $70. Why $70 you're gonna hand over? Because the company is going to pay 30% to the Austrian government tax office. Then the question come up, why you pay 30%? My tax rate is 19%. Then the company will say, because company rate is 30%. That's why I'm paying 30% to the Austrian government. Now, how do I get my money back? Oh, tell ATO that this much is my franking credit, but my tax rate is 19%. Okay. Then they will refund you the money. But the same way, 32.5%. Okay. So again, you have to add it back. So they are actually, so how much was there for them? It will be 32.5. Okay. 32.5 and oh yeah, 30% they have paid tax. So it will be like 2.5. So 100 minus 32.5 it will be here. So gross tax on grossed up income is 32.5% tax has been paid, but the company has paid 30% only. So you have to pay 2.5% back. Okay. In this case, $100 is dividend again. $100 is a dividend, but as a company, they paid only 30% because that's what the company tax rate is. So you might be happy that, oh, okay, my tax rate is normally I pay 32.5% tax. Okay, another group just said I'm going to pay 32% tax is my normal tax rate, but company paid 30%. No, you have to pay another 2.5% in your tax return. Okay, so another group, if they are in a high income, 45% tax is high income group. 45% tax they pay normally, individual tax rate. But again, company will pay 30% only. Rest 15% they will have to pay in their tax rate. That's what it is. All right, so here is example is in here, another example is in here. Couple of examples have given in here. Oh, okay. I think that's all we got in here for today. Okay, let's do some problem solving from last week, what we have done. What is leasing? Define, compare, and contrast operating leasing and financial leasing. Okay. We'll do this one now. And let's see what we got. Let me check this out in here. What is leasing? We done this last week. So leasing is a financial technique that allows a firm to obtain the use of certain fixed assets by making periodic contractual payments that are tax deductible. What is a leasing? Leasing is it's an agreement that the lessor as a lessee pays to the lessor. Why they do that? Because they do that because they're using their machine, which they could not buy. They will be using the machine under leasing, and later on, what they're gonna do depends on what type of lease they have. Is it financial leasing or is it operating leasing? An operating leasing is contractual agreement whereby the lessee agrees to make periodic payments to the lessor 5 or fewer years for an asset service. Such leases are generally cancelable at the option of lessee, who may be required to pay a predetermined cancellation penalty. Assets leased under the operating lease, such as computer, generally have a usable longer time, like longer than the terms of the lease. Therefore, normally the assets have a positive market value at the termination of the lease. And what about financial lease? A financial lease is long-term lease than an operating lease. It is non-cancelable and therefore obligations the lessee to make payments for the use of an asset over a predetermined period of time. If you cancel it, you have to pay for that. Financial leases are commonly used for leasing land, buildings, large pieces of equipment. A big amount is financial leasing. All right, let's move on to the next question. Okay, near lease or buy purchase. That's the option. Good. A private radiology clinic wishes to expand its facilities with an additional ultrasound scanner. Okay. A scanner can be leased or purchased. The purchase price would be $150,000 and there would be no installation cost. The firm running the clinic is in 30% tax bracket and its before tax cost of debt is 10%. terms of the lease and purchase alternatives are as follows. There is the lease term, and here is the purchase options. The lease term would be 3 years and would require annual lease payments of $54,000, with lease payment made at the beginning of each 12-month period of time. The lessor would pay all maintenance costs, but insurance and other costs would be borne by the lessee. All right. The lessee would exercise an option to purchase the asset for $25,000 termination of the lease. After that, the end of the lease term, they can buy the item by paying $25,000. Or and the purchase options, if the firm purchased the scanner, there is ultrasound scanner, right? Yeah, ultrasound scanner. If the firm purchased the scanner, its purchase price is $150,000. Will be borrowed at a before tax interest rate of 10% per annum. The loan would be repaid with 3 equal annual repayments, each of 60,317.22 each, which is the first repayment made at the end of 12 months. After 12 months, we make the first payment, so end of the year payment. The purchase price of the machine would be fully depreciated using the prime cost or straight line method over the 3-year period. The firm would pay $2,000 per annum for a service contract that covers all maintenance costs, insurance, and other costs would be borne by the firm. The firm would plan to keep the equipment and use it beyond the 3 years of operation. Note that since the firm running the clinic pays insurance and other costs of operating any scanner regardless of whether it is leased or purchased, this cost need not be considered in making decisions. You don't worry about other insurance programs. Okay. Calculate the after-tax cash outflow associated with the leasing, okay, of the ultrasound scanner. If T is measured in years, this will be involved. Okay, let's talk about this one. Okay, so 3 years, T0, T1, T2. That's what we're gonna do. Okay, T0, T1, T2, T3. Subsequently, they calculate the present value of T0 of the after-tax cash outflow associated with the leasing. All right. How much tax shield? How much tax shield will be there? Tax shield for years 1 to 3 will be $16,200 per year. Okay. So tax shield is $16,200 per year. That much tax saving. Yeah, 0, 1, 2, 3, T0, T1, T2, T3. Third year is after 3 years, fourth year termination year. Okay. The lease payment will be how much? $54,000. They already mentioned it in here. $54,000 will be your lease payments. Okay. Tax shield is $16,200. Tax shield is after 1 year because tax will be notified after 1 year. That's why first year there will be no taxes on the system. Nothing to come from the tax shield in the first year. Okay, so at T0 we do not know. After 1 year we lost the tax, then we know only the tax shield. Okay, the first year after tax cash outflow will be 54,000. Second year it will not be 54, it will be 37,800. Third year 37.8 again. But in the fourth year, okay, you can pay $25,000 and buy the item. Remember it says there, yeah, the lessee would exercise an option to purchase that asset for $25,000 for the termination period. Termination of the lease. After on fourth year, they're gonna make a payment of $25,000 and get the money. Okay. So how much will be after tax cash outflow? Add them all up, you will know this. Now, after tax cost of debt will be how much? It will be 7% because they say here 10% is the cost of this. Where is that 10%? Yeah. That's when it's before tax cost of debt is 10%. So if you purchase something on 10% interest because of the tax, because that amount will be your expense. So you can actually show this expense as a business expense. As a result, 30% tax you will not have to pay. Okay. So that's why they will subtract the 30%, 70% will be 7% will be your rate of interest. Okay, so present value after tax cash out plus with the lease will be how much? It will be this one. First year is 54. 54, second year is 37.8. 37.8 into 1 plus 0.07, 7%. That's how they calculated this thing. And why it is actually 2? It is 2 because we have here 2 years same figure. That's why they have applied here the annuity figure, annuity equation. Okay, so 2 years, 37.2, 37.2. Okay, that's 2 years. Okay, twice. Last year is 8,800. Okay. So you might ask questions, where is another 37.8? Because it's 2 years. So total lease payment will be your 129,526.51 is your lease payment total. Now, if you go to purchase it, I think that's what they're going to say here. Calculate the after-tax cash outflow associated with the purchasing of this scanner. What about if you purchase this thing? Purchasing, they said already that you have to pay 60,000 this much money, and every year goes repayment. Is 60,317. You can see it in the 60,317.22. All right, so in this case, you can see that depreciation will be, the item will be, this scanner will last for 3 years only, lifetime is 3 years. Every year will be 50,000 because they mentioned here that it will be depreciated with the straight line method, prime cost method, straight line method, about 3 years of period. And depreciating tax savings will be $15,000. Since depreciation is also business expense, you can save 30% from the tax as well. So first year you have to pay, how much will be your principal outstanding? $150,000. The amortization table, how much they're gonna pay for every year? The payment will be 60,000. Out of 60,000, interest will be subtracted first. 10% interest subtracted. How much is left over? 45,000. That will be reduced from the principal amount. Okay. Then again, you have to calculate how much is principal amount paid. 45,000. How much is left now? 150 minus 45. Again, you pay 60,000. Out of 60,000, you have to calculate from here 10% of this. 10,000 for 68.28, and the rest of the amount that will be interest expense. Rest of the amount of $60,000, which is 49,848.94. So that's the principal amount will be reduced. So in total, now you see your cash outflow. Now you're going to calculate the how much cash is outflow. First, we actually decided here that how much principal amount will be paid, how the principal amount will be paid. Now we are going to calculate the net present value. Okay. Before we go for the net present value, let's see if we have any other expenses associated with this purchase or not. We found these expenses. Depreciation is 50,000, interest is 15,000, maintenance is 2,000. Total tax deduction will be 37,000. Now, how much you will get from the tax shield? 30% of this. Okay. And after tax outflows will be 42,000. We calculate the all same thing for 3 consecutive years. And total tax deductions will be 67,000. How did they get this figure? Tax shield, 30% of 67,000. Okay. So after tax outflow for the year 1 will be how much? 60,000. 317 plus 2,000 minus 20,000. This much. Where this 2,000 coming from? This will be your actually this maintenance things is coming up in here. Let me show you. There's the depreciation, the count depreciation in here. Oh yes, depreciation is counted here too. So now we have to calculate the present value of these 3 figures. Okay. 42, this and this. Look, this is not the same figures. We cannot apply the annuity formula here. You see, normal here we applied normal present value formula. Okay. So future value divided by 1 plus n to the power 1. So these one actually have 1, 2, 3. Simple. But if we had this any figure was same figure, that then we to reduce the calculation part, we could use this formula. But it's okay. You understand these things. And the market is 140. So if you go for a purchase, you have to pay 114,000. If you go for leasing, you will have to pay 129. You'll definitely go for purchase. So purchase is perfect. That's it, nothing else. Consider a call option to buy 1 share that is purchased at a price of $1 with a strike price $12. Remember the call and put, call option, put option. That's the one. Draw a profit diagram for the option from the option buyer's point of view. Measure the share price on the horizontal axis, profit on the vertical axis. Explain the diagram. So the share price in here, profit in here. All right. So call option. Consider call option to buy 1 share that is purchased at the price of $1. The purchase at $1. Call means you are buying. Put option means you are selling. Okay. Call, you mean you buying it back. Call. Put, you put somewhere, it means sell. Remember that way. Most of the students just get confused with this one. First question is, what is the intrinsic value of the call option if the share price is $11? Okay. So they said that if the share price is $12, that's the time they're going to buy. If the share price is $11, would they buy? No. Zero if the share price is 11. When they go for 12, they will strike. Consider the following profit diagram for the share option. Question 1, 2, and 3 below refer to this diagram. We'll take it to the next page. That's better. All right. Okay. $9 is nearly the strike price. Let's see. State whether the above diagram is for a put option or a call option, or whether it depicts the profit to the seller or the buyer for this option. From this diagram, you have to say it is call option or put option. Which one is this one? Anybody want to give a try? Anybody want to give a try? This is actually a put option from the buyer's point of view. Okay, this is a put option. Yeah. So to the seller or buyer point of view. This is the put option from the buyer's point of view. Assuming one option contract is for 1,000 shares, what is the intrinsic value, fundamental value of an option contract with the share price in the market is $10. So look at here, $9 is, so this is actually your put option. So this, you can see the $9, you can buy it at $9, sell it at $9 when the strike, when the price goes at, let's say 8, you can sell it at 9 and make a profit out of it. Okay. How much would be the intrinsic value at that time? Okay. They said that $10. Would you, $10, the market price is $10. Would you practice to sell it at $9? You will not. Right? So the market value is $10. So your deal was that if it strike at $9, they can say they will sell it. You see, why would you sell at $9? If it's the market, if you go to the market, you can sell it at $9, $10. Would you sell it? No, you will not sell it. Intrinsic value will become 0. Again, assuming one option contract is 1,000 shares, would it be overall net profit to the holder of one option contract if the option is exercised when the share price market value is $6? Market value is here, how much? $6. You can sell it at $9 now, so $3 will be your profit. So $3 will be profit for one share, 1,000 share will be $3,000 will be your profit. Very simple. All right, $3,000 will be profit, but from $3,000 you have to give $1, like they said, mention it somewhere here. $1 is your expense, business expenses. This is here. So here, so $9 is the market. $9 is your strike price. You're selling at $9, but market price is $6. So you're making how much? $3,000. You're making a profit. But to get this benefit, to get this put option, you have to spend $1,000. Subtract that $1,000. Rest is $2,000 is your profit. Okay. All right. Number 5. Any questions for me, guys, so far? Any questions for me? No?
All good. Everything's fine.
This question will not be in final exam, but just for you to have a look. Bill Polaski holds 6,000 shares in SMT Transport. He bought the shares several years ago at $4.85, and the shares are now trading at $7.50. The market price is $7.50. He purchased at $4.85. All right. Bill is concerned that the market is beginning to soften. He doesn't want to sell the share, but he would like to be able to protect the profit he has made. He decided to hedge his option by buying 6 puts on SNS. Okay. SNS is a company name. The 3 months put carry a strike price of $7.50, and he's currently trading at 0.50. How much profit or loss will Bill make on this deal if the price of SMC does indeed drop to $6 a share? by this expiration date of this put for 3 months, right? All right, so this says here that how much did he bought this share for $4, 4.85. Current market price is 750. Okay, and market price for 3 month put is 0.25. It means for he will have to pay 0.25, 25 cents for each put. I think this is costing to have that, to purchase that agreement. All right, so like it's like a certificate. Like if you buy this certificate, that you can, if the market price goes like 70, goes below, you can still sell it at 750. It's okay. But to buy that certificate, you will have to pay 2.5, 0.25, 25 cents. So now if share price drops to $6 3 months later, he can still sell at 750 because of the certificate. Which certificate? Put certificate. Okay, so he will make $1.50 of profit, but this 0.25 needs to be subtracted to understand the expenses too. Okay, so either 6,000 shares. Okay, 6,000 shares into 1.5. Okay, sorry, 6,000 shares into 6 minus 4.85. 6,900. Value for 6 put is $9,000. Cost of 6 put is 6 into 6,000. This is actually costing, so it will be like 0.25 multiplied by 6,000 shares, $1,500. And this is the thing, is profit he is making $9,000, right? But the question is how much profit he is actually making. Look, he bought at 4.85. Think this way. How much profit this agreement, this put agreement or put contract is giving him? That's the question. If he did not have these put options, how much profit he would have made? He would have made 6 minus 4.85. $6,900 profit he could have made. Okay. But because of value of 6 puts, he'll be making actually $9,000 in here. Total profit will be $14,400. Now the explanation is here. With the share trading at 750, Bill has already made a profit of $15,900. His intent is to protect this profit with a huge hedge. If the share price drops to $6 per share, his profit will go down to $14,400 as shown above. His profit decreases by the cost of 6 put by $1,500. Okay. B, how much would he do if the share kept going up in price and reached $9 a share by the expiration date? $9 a share. All right. So $9 will be 9 minus 4.85, the same thing we're gonna do. Okay. So he's not gonna use that put options because price is already $9, which is much more than 7.5. Okay. And he will use that agreement. He will use that contract, but he still needs to pay for the expenses. The thing is, look, it's very simple. If you see that you purchase an agreement, which is like if the price goes above or goes below $9, for example, okay? So it tells you that at what price you can sell. You can sell at $9, fine. What is the market price? Market price is, let's say, $12. You need to sell $9? No, you're gonna use the market price. If you take it to the market and you sell it to the market, you're not going to actually use that put options. That's all we have for today. Anything you guys want me to recap or anything?
Nah, it's all good.
I just